Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Brian Stutland, Chief Investment Officer at Equity Armor Investments, to discuss some of the moves that we're seeing in the market. And Brian, it's so interesting, despite the volatility that we're seeing, in many cases stocks round tripping on any given session, options prices and volatility seem relatively cheap here.
They really do, Jill. It's unbelievable. I mean, when you look at option traders out there, they're getting such cheap value to buy a call if they want to express interest in the market going up, or buy a put to protect their stock, or play a short side bet to the downside and buy a put. Because these volatile moves, 4% down in the S&P, the Nasdaq down 5% yesterday. Had you bought a put, that wasn't very expensive to do, and it paid off big time yesterday on these moves. So we're getting wild swings. I'm surprised option traders are at least raising the value of some of these options to make these plays.
And Brian, you know, at some point when we think about the mega cap growth names, the Apples, the Alphabets, the Amazon, Microsoft, of course, they're going to start to look like value stocks at some point.
They really are, Joe. I mean, when you look at it, and maybe this is why options are cheap, because when the market goes down and the Nasdaq goes down as much as it has, people turn and look, and they say Apple, Google, Microsoft, which are stocks we own and invest in. But, you know, you take a look at those, the cash balance is there for them. They borrowed billions last year at very low interest rates. It's almost like they've got to refinance before rates have moved higher. So they are definitely well positioned. If the market continues to go lower, they're well positioned to buy back stock, do things with their cash in order to buoy this market. And maybe that's why volatility and option traders are not buying the downside put, so worried about it. But I think there are some critical levels that you've got to be careful of.
Right. Let's talk about earnings for a bit here. Cisco, does it deserve to be down as much as it is today, or was?
Well, I mean, look, we own that stock as well. It's taken a pretty big hit here. I think if you look at a lot of the earnings that have come out recently, if you've missed, or those companies have missed a little bit on the earnings plate, those stocks have gotten shellacked to the downside. And so it looks like you kind of have to play it where wait for earnings to come out, wait for valuations to come down, and then look at that as an opportunity to buy. I like Cisco obviously a lot better today than I did before. But I think that's what's going on, is people are just selling first, asking questions later, and the earnings wasn't that great for Cisco. A little bit of worried about the supply chain issues that we continue to see out of China affecting Cisco. And so that's, certainly, warrants a sell-off in the stock. But now we're getting to levels where when you see these stocks start to get hit, I'm looking at trying to acquire some of that.
Let's talk about Walmart and Target for a moment here, because the consumer is so crucial to the U.S. economy, in fact, the global economy here. And that was an issue where we're not even talking about supply chain, but inventory levels as well. I never thought in my lifetime, or at least in my financial career, that we would see a Walmart and a Target down by the percentage that they were.
Yeah, I mean, and that's what I'm talking about, Jill, is like they come out with some earnings play, they guide maybe a little lower, they're a little concerned about somewhere in their earnings report, and the stocks are just getting hammered and punished for it. And in some ways, almost over punished for it. So it's just kind of like, hey, the earnings came out, let me get out of here right now and run somewhere and hide somewhere else. And I think that's the wrong trade to do if you're a trader, because this is such a trader's market. When things get sold off really hard, it's probably an opportunity to buy and then wait for the rip higher to get out.
Right. It makes you wonder. The quarter that was just reported was the first quarter, and I feel as if the pain that we're seeing, especially with inflation, prices, the pump, prices for groceries, baby formula shortage, you name it, supply chain constraints, that hasn't, that really happened in the second quarter. We should hear more about that, in the next reporting cycle. So I wonder if these extreme moves are perhaps pricing in what the market expects with Q2 reporting.
Yeah, I think it's starting to move forward and guide already and get ahead of it, like you just mentioned. And so for that reason, I think if stocks are getting a little overhit from an earnings report, it's probably an opportunity to buy. But we are at some critical levels here in the market. 3,900 here on the S&P, 12,000 in the Nasdaq, or 11,800. 11,800 would represent a 50% retracement from the March lows in 2020 to the highs in the market. So we've got to watch that level, 11,800, because if we get more selling pressure, then some of these sell-offs and valuations are not just being taken down for a PE valuation going lower, after the Fed starts raising rates, but they're in fact looking out, maybe a little bit more ahead that, hey, a recession or a deep recession is coming, and watching out for that. So watch for that 11,800 on the Nasdaq. That's an area I want to see the market get support at.
All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.